Yeah, so there's lots of reasons why implementations fail. And I mean, a single family office systems implementation. And most of them are not due to some technical problem, as we've discussed. Most of them are due to unforced errors or mismanagement. And um, we're going to talk in a little bit of depth about that today with our special guest, Chris Dickson, who is a senior manager in the family office advisory practice at RSM, a leading accountancy and consulting firm. And Chris has well over 10 years experience working with ultra high net worth families and also in the fund admin business, but most recently working, I would say, exclusively with single family offices on risk management, operations, and of course, technology, which is the topic for today. So I want to say welcome, Chris.
Thanks, John. Appreciate the opportunity to be here today, and it's always a pleasure to talk to you.
It's great to have you with us. Before we get started, I just want to say that this video is sponsored by FundCount. And FundCount is a world-class technology platform that is in service to the wealth management industry and single-family offices especially. So thank you, FundCount, for supporting these conversations. So, Chris, let's get right into it. I mentioned, and we've discussed that um, failures in system implementations are not necessarily technical. And by failure, look, I don't misunderstand me, that very few implementations fail outright. Maybe 1 out of 50 or 1 out of 100, they just give up and go back or don't implement. So that's very rare. But what I mean by failure of an implementation in a family office is failure to meet the budget as agreed, failure to meet the time frame that was agreed to, or failure to satisfy all of the business requirements that were outlined, to be completed. So, Chris, with that in mind, what do you see as, sort of the top reasons that single family offices struggle and sometimes fail to get the system implementation done successfully?
John, I think you hit the nail on the head spot on. Often technology selections and implementations don't fail because the system that was selected fails to operate as it was intended. Typically, what I see is that technology implementations fail either due to decisions made during the implementation process, or more commonly due to kind of root causes that stem from how and when the system was selected in the first place. And those root causes tend to span various considerations. Sometimes it's a people issue, sometimes it's a process, in other instances, it's data or governance. And I'll kind of dive into each of those a little bit further to kind of highlight what I've seen. So maybe I'll just start with the people. And what I mean by the people isn't necessarily the skill sets or the experience of the people that are supporting the selection and the implementation process. It's more often than not a lack of involvement from all of the people that would be impacted by the future technology that's being put in place. Often what we'll see is if an accounting book of record or a financial general ledger system is being selected, that tends to be spearheaded and driven by the accounting or the tax team. If an investment performance and risk analytics system is being selected, that tends to be driven by the investment management team within a family office. This isn't always the case, but sometimes it gets driven in silos. And for example, when you're picking a financial general ledger, obviously getting input from the accounting and tax team is important, but that system is going to impact many more users, and they're going to be required to get you certain data sets to complete your accounting needs for reporting purposes. So it's important to include not just accounting and tax, but the HR team, the investment management team, the legal team, a charitable team, if philanthropy and foundations are a core part of the family office. So really, from a people standpoint, it's lack of including them up front, which can often mean to missed business requirements that are critical for accounting and reporting purposes. When I'm talking about process, what I mean is that in family offices, what I've seen is that policies and procedures aren't often documented, which in those situations often leads to inconsistent application of that process or that workflow within the family office. So as a smaller team is responsible for selecting the right system, they may be viewing the process that's going to have to be deployed in the new system through their lens without realizing that other people in the organization do the process slightly different or rely on different data sets than they do. So it's important to kind of think through what the current state process is from an end-to-end standpoint as you're implementing that new system. That process most likely is going to change. So you really need to have a firm basis of understanding of the different ways the process is being deployed within the family office. The last two areas are really data and governance. From a data standpoint, I'm going to mention from two areas. It's the decisions made around historical data migration, meaning that, hey, often from an accounting standpoint, there are decisions made to do a balance forward or to bring over the last 2 years of historical information. That's great from an accounting and financial reporting standpoint, but gets a little bit more complicated when you start throwing investment performance into the mix, because from an IRR standpoint, you really need to bring over all those historical cash flows or the IRR isn't going to calculate correctly. So that's the data migration piece. The next piece is the data quality. Is in instances where the current accounting system may have inconsistent chart of accounts or may have incomplete data, it's important really to get your arms around that and make sure the data integrity is as tight as possible before the system implementation. Because if you begin the implementation and then have to solve the data quality issues, the process is going to extend, the cost is going to go up, and frustrations are going to arise. All of which leads to my last point, which is governance. Often what we see is family offices rely on their accounting team or their tax team or their day-to-day operators really to drive that system selection and implementation forward. But those people have day jobs and they're responsible for significant workloads that they already have to get done in conjunction with driving the selection implementation process forward. So what we see is that it would really be beneficial for many family offices to deploy a project management office where they have one person responsible solely for driving the strategic initiatives of the family office forward and really coordinating calendars, setting schedules, providing status updates, and really just supporting communication throughout the process.
Well, thanks for that, Chris. That's a very complete answer, and I appreciate your approach from a people, process, technology standpoint, and actually business process improvement is key to a successful systems implementation. There's just no question. In fact, it's a great opportunity for the business to reorganize the work that it does, the way it does it, who does what, and to the extent that the new system will automate certain types of transactions, capture, or activity, makes a lot of sense to engage in business process improvement. And so I know you've seen that, and I know you recommend to your clients that where possible, they take advantage of the new system's capabilities to improve their process. Maybe you can talk a little bit about experience you've had working with single-family offices to improve their business process as a part of the implementation.
Happy to. Business process improvement or optimization, whichever word you want to use there, is very important to undergo as you're considering implementing a new system. Why? I personally love the technology selection implementation process. Many people can't say the same thing. People aren't implementing new technology out of a mere desire to implement new systems. They're implementing new technology to address existing operational deficiencies and to really ensure that the family office is well positioned to address not only current needs, but future needs, either from a business model standpoint or a rising gen involvement situation. So really, they're implementing it because there are deficiencies in the current operations and they need to enhance their digital footprint in order to address those. Part of that is recognizing that So let me take a step back. So as they're going through that process, they recognize that there's deficiencies, but it's human nature to be accustomed to doing things the way things have always been done. And like I mentioned before, it's not uncommon for processes not to be documented within a family office, which leads to inconsistent application of business process. So when we approach business process optimization through the lens of technology selection and implementation, it's really intended to serve two purposes, all of which help lead to a successful implementation. Purpose number one is to ensure that there is a sufficient understanding of what that current state process is. It doesn't benefit anybody if the current process is being deployed with slight nuances in 5 different ways. So it's important to sort of get your arms around what is the tried and true way to get an accounts payable invoice paid, or a capital call processed, or a balance sheet prepared for a family member. What are the core ways the family office should and are operating today to do that? You document all of that so that way there's a foundation for when that's going to be reconfigured within the future process. The second reason why you do that is to ensure that all stakeholders that are really supporting that understand that the process is going to change. And if they understand the process is going to change, and they understand why it's going to change and what are the benefits to that change, either from an effectiveness or an efficiency or a control standpoint, there'll be more buy-in. Nobody wants to go into a new system not understanding how their day-to-day operations are going to be impacted and what life is going to look like post-selection. So it's important to get that buy-in up front. Where I think this is even more critical is when family offices typically implement a new system from a client wealth reporting standpoint. There's conversations about, hey, I have an accounting book of record that needs to be addressed. I have an investment book of record that needs to be addressed. There are certainly those systems that blend the accounting book of record with the investment book of record and support comprehensive reporting natively within their environment to their families. Certain situations, they tend to go a standalone accounting book of record, general ledger, or an investment book of record, which means you now have disparate systems that are going to have to be reconciled between the two, with data flowing between the two systems. So not only do you need to understand the current process and how that's going to change within the new environment, you need to understand what additional processes may need to be deployed and what are the most effective, efficient ways of doing those to support data transfers between systems and reconciliations between systems when you don't go that all-in-one comprehensive route.
So, are there specific examples where a business process improvement has resulted in cost savings, let's say, or productivity enhancement, and labor productivity, or a quality upgrade that you can give us to demonstrate the impact, the positive impact of a review and potentially enhancement of business process during an implementation?
For sure. I can give a few examples, but before I do, if you don't mind, I might go off on a slight tangent here, because what I often hear when we're going through these processes is what are other family offices doing from a process standpoint? What is considered best practice? And to me, the idea that there's a one size fits all solution for how a process should be designed and implemented in a family office may sometimes be an oversimplification. Each family office is unique and does often require processes that are tailored to their specific facts and circumstances. So while there are business process activities that are commonplace and would be considered leading practice or best practice, the way of designing that process within an organization needs to be constructed in a way that is best fit for their needs. It needs to balance effectiveness, efficiency, cost, and risk management. It's crucial to not over-engineer a process to the point where it hinders kind of like operational efficiency. You don't want to have it be so bureaucratic that you need to go through 5 layers in order to get something done. But you also don't want it so efficient with limited controls that it poses a risk to the family. So, for instance, in many smaller and moderate sized family offices, it's harder to fully design segregation of duties within a family office. It's hard to separate the accounting function from the treasury function from the operations function within there, because we're not going to be building out multiple departments all of the time just for the purposes of segregation of duties. People wear many hats within a family office. So in these circumstances where segregation of duties may be lacking, control often shifts upward, with family members needing to either sign every check or to authorize every wire transfer. Direct control sometimes works for some families, and they love that. But it's less effective for others. So that's why it's important to really kind of think through, how should a process be designed for a family office? What are the trade-offs that are going to be made in that decision? And what is that appropriate balance of effectiveness, efficiency, risk, and cost? So sorry, love process optimization. Appreciate you bearing with me for a second. Gonna get to the specific examples. So there are three that really come top of mind. So I was just talking about cash disbursements and accounts payable process. That is one efficiency I see all the time by putting in place a new system. It's not uncommon that family offices may use paper approvals, or maybe getting text approvals, or approvals via email. And when that's done, it's really hard to kind of understand where a process is or where an approval is in the workflow. So what we found is that by automating the accounts payable workflow within a system, it helps to prevent bottlenecks, improve transparency and accountability throughout the workflow, and really just move things along in a way that is just highly transparent. Often nowadays, there are mobile applications associated with accounts payable workflows. So you could be on a beach approving a wire transfer. Probably not the best internal control, but it prevents you from having to be in the office at 7 p.m. at night just to approve a cash disbursement. You can do that mobily in a safe, secure, encrypted manner. Another example involves really kind of streamlining personal net worth statements. So this can be challenging because a personal net worth statement requires you not only to have a solid accounting book of record and financials, but also requires you to blend the portfolio of the family into the balance sheet and income statement. Often this is done through two different systems or done through one system and external service providers, which often leads to significant manual workflows in order to really kind of prepare these annual net worth statements and issue them to the families. So we tend to see this be done once or twice a year in many family offices. But technology selection and implementation gives you the opportunity to automate a lot of that as you're thinking through digital transformation, which means that family members could be getting ready access to information much more frequently and understand their personal net worth more than just that once or twice a year. They may be able to log into that and see a real-time dashboard, as real-time as can be, depending on their asset classes that they invest in. But real-time kind of understanding of what their portfolio and their balance sheet looks like, because they're receiving data feeds from their banks, their custodians, their brokers, or even automating the alternative aggregation or alternative investment aggregation. The last piece I really see is really just the ability to speed up insights from an executive standpoint. Getting into an accounting system or investment system can sometimes be intimidating, not so much for the senior accountants or the controllers, but can be intimidating to executives that have a lot on their plate and a lot of decisions that need to be made. So we're seeing a lot of tech providers nowadays building role-based really dashboards into their platform. So if a CFO needs to log into a system, they don't need to navigate the screens and run a report in order to get the insights that are important to them. Their homepage is going to reflect the CFO level dashboard that's important to them, whether that be liquidity, whether that be workflow approvals, whether that be a snapshot of the balance sheet. It makes it easy and intuitive for somebody to come in and see what's important to them right then and there.
So thank you, Chris, for sharing your thoughts and opinions today. I want to mention to everybody that Chris and his team at RSM produced a report earlier this year, and I think it was published in February. And we'll make that available in the link below. And of course, you can find it. You can Google it and find it. But it's focused on single-family office benchmarking, and based upon a survey, I think, of 100, maybe just over 100 single-family offices in the U.S. and Canada. So check that out. Chris, again, thank you very much. I'm John Carroll, your host for the Family Office Project, saying see you next time.
Thanks, everybody. Take care.